Super. So I think we'll get cracking. So good morning, everybody, and thank you so much for joining us for this webinar, which is focused on the Charities SORP Exposure Draft. My name's Fiona Condren, and I'm BDO's National Head of Charities. And today I'm delighted that Sarah Anderson, a partner in our Leeds office, and Robin Harwood, a senior manager in our technical team, have kindly agreed to join me to share their insights into the key changes which are being proposed. The session is being recorded and will be shared with you in the next few days. So if you've missed anything or want to share the content with colleagues, there will be a chance to catch up. The slides will also be available to download, which I think will be enormously helpful as we take you from the theory to some of the real life examples and issues you will need to consider. At the end of Robin's session, we'll move to a panel Q&A where we'll answer some of your immediate questions. So please do use the Q&A function below as and when you think of questions, and we'll try and get through as many of them as we can. At this point, we'll also be joined by Frederic Lecatu, who leads on BDO's Financial Reporting Advisory Service and who's already guiding charities through their plans to transition to the new standards. The session will conclude no later than 10:30, so if we can't get through all questions, then we'll endeavour to respond to you after the event. And we'll also signpost our future events where we will continue to guide you through the new requirements later in the autumn once we have a final version of the SORP. So without further ado, this is the agenda slide for the next hour. And I just want to get started. So I'm going to start with a quick poll just to make sure you're all awake and listening this morning. So the poll question here, I'm just going to give you 15 seconds or so to answer. How familiar are you with the Charities SORP Exposure Draft right now? So the options are: I've read it in detail, I've started to take a look, it's on my to-do list, I'm not familiar, and I probably won't have a chance to read it in detail. So just give you a few more seconds to answer that poll. Super. Should we have a look at the answers? Great. So half of the people here are saying that it's on the to-do list, which is not surprising really, because it's a long document and there's a lot to get through. Some people have started to take a look and that's great. So I'm really optimistic that this morning's session will really help to inspire you to spend a bit of time over the next few weeks looking at some of that detail and thinking about the implications. So if we can just close that, we'll move on to the next slide. So a very quick reminder of how we got to this point. The timetable set out on this slide is from a SORP project update issued in December. It's important to note that this timetable still remains in place. We're now in the 12-week consultation phase on the amendments to the SORP. It launched at the end of March and it runs to Friday, the 20th of June. The questions posed by the consultation can be found on the SORP website, and we'll provide details at the end of this session of where you can find those links. The current project plan expects an updated SORP to be issued in autumn 2025. In reality, I don't think it's going to come out before the 31st of October. The effective date of the SORP will align with FRS 102 and will be effective for periods beginning on or after the 1st of January 26. So the SORP Exposure Draft update combines application guidance relevant to FRS 102 amendments from the perspective of the charity sector. In particular, it now reflects changes to how charities need to recognise certain types of income and certain types of leases in their accounts. For example, it provides guidance on the treatment of leases with peppercorn rent or where a social discount below market rental values is applied. The consultation is seeking views on how the revised requirements are explained in the context of charities. The changes are driven from those finalised in FRS 102, and just remember that every SORP must maintain consistency with UK generally accepted accounting practice under the FRC's policy on developing SORPs. The exposure draft also includes updates to sector-specific requirements set out in the SORP as part of the periodic review and input from a number of different engagement groups which met throughout 2023, looking at the needs of the SORP from the perspective of different stakeholder groups. These proposed amendments relate to areas that are within the discretion of the SORP making body and included amendments to disclosures required in the Trustees report. Preparers can adopt the 2024 periodic review amendments to FRS 102, and the amended SORP will also be available for early adoption. The amendments to the SORP and FRS 102 must be applied at the same time, however, and this could be relatively challenging if the final version of the SORP isn't issued until late autumn, and therefore I'm not sure I anticipate many charities want to take that option. The SORP making body is inviting comments on the exposure draft prior to the publication of that final version. As I said, it closes on Friday the 20th of June, and we strongly encourage all charities to engage. The SORP making body is clear that it's keen to hear the views from a range of stakeholders that prepare, scrutinise and use charity accounts, so this really is your opportunity to engage and input into the proposed changes. So the SORP making body have published a summary of the key changes by SORP module, and this next couple of slides sets out the modules where significant changes are identified or new modules are being introduced. This summary excludes modules where limited or only editorial changes have only been identified. I'm going to touch on the tiered reporting in a few areas where there are proposed changes to the Trustees report, and Robin's going to cover income in more detail shortly. On the next slide, you can see some of the changes that are proposed. Sarah's going to cover the key bit here on leases. And I'd encourage you to watch out for that cash flow exemption. Again, Robin's going to mention it, but if you're under the threshold of 15 million, but you still don't qualify as a small company under the Companies Act, you won't get an exemption from that cash flow statement. So watch out for that. And on this slide, we're showing here there are moderate changes that are being identified in the three modules on this slide. With the exception of lease accounting and the identification of right of use assets, we wouldn't expect the impact on the balance sheet presentation to be very significant. So what are some of the proposed changes? Well, the first proposal is the introduction of 3 tiers of reporting based on income levels to try and get some proportionality whilst also meeting the needs, the information needs of users. The aim of tiering is that the SORP reflects the needs of smaller charities and reporting requirements are made more proportionate where possible. Subject to the consultation, new tiered reporting rules will be introduced and the tiers will have varying levels of requirements. And just by way of summary, the tiers are Tier 1, charities with gross income of less than £500,000 or euros. Tier 2 charities will have gross income of more than 500,000 but less than 15 million. And Tier 3 charities will be all of those with gross income of more than 15 million. The threshold selected to distinguish Tier 3 from Tier 2 only takes into account the gross income criteria used in defining a small company in company law and a small entity in FRS 102. And on this slide, you can see the modules where different requirements are being proposed based on those tiers. So Module 1, the Trustees report, Module 4, the SOFA, 8, allocating costs by activity, 9, disclosure of trustee and staff remuneration, related party and other transactions, and 14, the statement of cash flows. For all other modules in the exposure draft, tiering does not apply, and those modules will be applied in full to all charities where it's applicable. A summary of variation between tiers is provided at the start of each module in the SORP, although it's not currently possible just to narrow down the SORP to only those elements relevant to Tier 1, for example. We've already suggested that this could be something that the SORP making body considers when the final document is published. So the Trustees report, Module 1, has largely been rewritten with the aim of helping trustees to understand the narrative reporting requirements and to encourage a better link between the narrative information to the financial detail in the accounts. Narrative reporting isn't covered by FRS 102, and consequently the SORP making body has some latitude about what the requirements should be. Charities that are companies will continue to be required to meet directors' report and, where applicable, strategic report disclosure requirements. With regard to impact reporting, charities are increasingly required to explain the impact that they are making. As all charities exist to provide public benefit, it follows that they should be able to communicate the benefit provided to their beneficiaries that the charity exists to serve and support. Prompt questions have therefore been included in Module 1 for charities to consider and answer within the Trustees report. And there's now a focus on encouraging charities to report on the difference they're making and consequently the charity's impact on the wider environment. Tiers 1 and 2 are encouraged to explain how the charity is responding to and managing environmental, governance and social matters. Charities within Tier 3 are required to explain how the charity is responding and managing ESG matters. However, the proposals fall short of creating an expectation that non-company charities should report in line with the full SECR, that's the Streamlined Energy and Carbon Reporting Regulations. A large charity company will continue to fulfil those requirements. On reserves, there's an updated definition of reserves in the glossary and more clarity about the relevant disclosure requirements for the Trustees report and improved linkage between reserves policy and the numbers disclosed in the front end and the financial statements, as well as the going concern disclosure. Disclosure of future plans also extend to all charities in the exposure draft. The existing SORP requirement requires all charities to disclose in the notes to the accounts a description of the role played by general volunteers. Some of the disclosure requirements have now been relocated to the requirements for all charities in the Trustees report. Requirements to disclose a narrative explanation of the scale and nature of activities undertaken by volunteers exist in all tiers. And tiers 2 and 3 should also provide information on the number of volunteers, and where practicable, the contribution of volunteers may be expressed in terms of full-time equivalent hours. For going concern, there are proposed amendments to ensure consistency with FRS 102, including around the disclosure of material uncertainties. In addition, a new requirement has also been included, such as reserves or negative net assets on the balance sheet. It must explain why it's still operating as a going concern. And finally, legacies. There is a requirement now for Tier 2 and Tier 3 charities to provide a narrative explanation of how legacies are included in the accounts. This seems to me to imply a more granular accounting policy will be required. And this reflects the issue that there are more significant amounts of legacy income recognised that is accrued rather than received, and that additional disclosures will help the users of the accounts. So that's my whistle-stop tour. I'm going to pass over now to Sarah.
Morning, everybody. Thank you, Fiona. So I'm going to take you through the lease module. In the next few slides, we're going to go through the leasing module in a bit more detail with some worked examples. Our January charity update webinar covered the changes from current FRS 102, and that is also available on our YouTube channel should you want a refresh of the key components there. The draft SORP introduces the new module 10B to assist preparers in capturing the amended lease accounting and the disclosure requirements. As a reminder, the amended FRS 102 removes the distinction between operating and finance leases for lessees, with more leases now being recognised in the balance sheet as right-of-use assets. The draft SORP provides application guidance for charities applying amended FRS 102 in particular, gives detailed guidance where lease arrangements are below market value or at peppercorn value, as Fiona mentioned. But as always, the SORP cannot override the FRS 102 requirements. Key points arising from the draft SORP are firstly that not all arrangements entered into by a charity for the use of assets will meet the definition of a lease. Peppercorn leases at nil or nominal consideration are unlikely to meet the definition of a lease and hence would be outside of Module 10B. Secondly, the draft SORP introduces the term social donation lease. This is where a lessor seeks to provide support to a charity in delivering its charitable purpose and reduces the lease payments accordingly. There is therefore a non-exchange element in this type of lease arrangement, known as a social donation. Charities, you'll therefore need to consider the substance of your arrangements. For example, is a lease offered at low value? And if so, what's the reason for that lower value? Maybe the case that the lower value reflects a poor condition or restriction of the use of the asset. And in that case, the charity should consider whether the low value lease payment is a social donation or is actually in line with the market value. Here's a quick reminder of two exemptions available. One is the short leases, i.e. less than 12 months and without a purchase option. Secondly, there's an exemption for low value assets. Low value is based on the underlying asset value, not based on the value of the lease payments, and it's equally not based on materiality of the entity concerned. So some examples are given, like laptops, but there is no detailed guidance on what is defined as low value. Existing IFRS 16 does give examples of small items being office furniture and telephones. So there will be consideration needed regarding larger items, such as photocopiers, for example, and whether they are low value. It's also worth recapping at this point on discount rates. The lease payments included in the liability are discounted using the interest rate implicit in the lease, if that rate can be readily determined. If that rate cannot be readily determined, lessee chooses on a lease-by-lease basis to apply either their incremental borrowing rate or their obtainable borrowing rate. In the absence of an existing borrowing rate, the draft SORP requires that the use of a rate otherwise obtainable on deposits held with financial institutions should be used. However, this should be considered the last resort option and only used if other rates cannot be determined. A couple of definitions. Definition of incremental borrowing rate is the rate of interest a lessee would have to pay to borrow the funds necessary to obtain an asset of a similar value in a similar economic environment, borrowing over a similar term with a similar security. Whereas definition of obtainable borrowing rate is defined as the rate of interest a lessee would have to pay to borrow an amount similar to the total undiscounted value of lease payments over a similar term. So let's get into some practical examples. This first example is a straightforward office lease. No termination or extension options, a flat rate pattern of lease payments, and no initial lease costs paid upfront. It's a 5-year office lease, paying $50,000 a year, and the discount rate has been assessed by the entity, the charity, as 5%. It's currently classified as an operating lease. Here, we're illustrating what would be recognised in the financial statements under current FRS 102. In this case, there'll be a consistent expense each year of $50,000. The lease expense will be separately disclosed in the notes, along with details of the off-balance sheet commitment payable in future periods. Importantly, there'll be no balances on the balance sheet under existing FRS 102. In the simplest terms, the amended FRS 102 will require that leases not qualifying for one of the available exemptions we've already mentioned, including those that are currently operating leases, will be brought onto the lessee's balance sheet. There'll be a lease liability and a corresponding right of use asset. At the commencement of the lease, the right of use asset value will match the liability in most, however not all scenarios, one of those being where there's a social donation lease with a non-exchange component. We will cover these in the next example. Under amended FRS 102, the first step is to measure the lease liability. This is calculated by discounting the future lease payments at your chosen discount rate. You can see the calculation on this slide. The amount of $216,473 will be used in the double entry for the right of use asset and the lease liability. After initially recognising the lease liability, an interest expense of 5% on the opening position is accrued each year. The lease payments are deducted to determine then the closing liability position at each year end. The SOFR charge that you will see each year is a combination of the interest expense on the lease liability and the depreciation charge on the right of use asset. We'll look at that next. The liability due within 1 year is the amount of the liability that will be settled in the next year. But note, this is not simply the $50,000 payment in the following year. Instead, it's the present value of that payment, as the interest charge to be expensed in the next year is not yet included in the liability. The rest of the closing liability is presented at an amount due in more than 1 year. A good test, really, that the calculation has been applied correctly is that the lease liability table reduces to 0 after your final payment. And we show that in the bottom line for 2030 on this example. On the asset side, the right of use asset, which was initially the same as the liability, is depreciated on a straight line basis over the 5 years of the lease, assuming a cost model is adopted. In this table, we compare the total expense profile with that of the current FRS 102. You can see that the higher expenses are charged earlier in the lease term under amended FRS 102, but the total after 5 years is the same. The balance sheet totals will be higher under amended FRS 102, so you'll need to consider any potential implications. A few of these might be that the change in asset position on the balance sheet may impact covenant calculations for charities with current borrowing or planned future finance arrangements. The change in the liability position may impact how free reserves are presented in your trustees' report. Any potential changes in the balance sheet to asset values may cause charities to cross the audit threshold. So currently an independent examination is permitted if charity's gross income is less than 1 million and total assets less than 3.26 million. There is obviously also a consultation currently open on those financial thresholds in charity law, and that's running to the 12th of June 25, with one option to maybe include an increase this asset threshold to 5 million from the 3.26 million. Change may also impact whether charity meets the small, medium, or large Companies Act thresholds. So some things to watch out for. Our second example, similar to the first example as a starting point, but also has a social donation component within the lease. Remember, the social donation component is where the payments are below market value, but are higher than a nominal peppercorn amount. And as a result of the lessor choosing to accept a lower rent for philanthropic reasons. The facts are the same in this example, except the two in green there, where the market rental value of the office is considered to be 150,000 per year. And the charity expected to pay 75,000 as an equivalent for an equivalent office space elsewhere. As the draft SORP sets out when considering a donated service or facility, we need to consider the value of the non-exchange component to the charity. In this case, it would be the difference between the 50,000 payments and the 75,000 the charity would need to pay for an equivalent office facility. Therefore, a non-exchange transaction amounting to 25,000 each year. As with the first example, there will be a consistent expense each year under current FRS 102 and the SORP. The lease expense would be separately disclosed in the notes, along with details of the off-balance sheet commitment. In addition, as required by existing SORP, income and expenditure would be recognised for 25,000 each year, reflecting the value of donated facility to the charity, but that would have nil net impact on the funds each year. So, there's no changes in the calculation of the lease liability at the point of commencement, which continues to be, as you can see, 216,473 in this second example. But there is a change to the right of use asset, with the total value of the non-exchange element, the 125,000, being recognised as part of the right of use asset, giving a total asset value 341,473 in this example. The value of the non-exchange component is recognised on the cost of the right of use asset when the resources are received or receivable. The related income is recognised at the same time. That's assuming there are no performance-related conditions. And the SORP suggested this is unlikely in such lease arrangements. And this results in higher funds on the balance sheet at the commencement of the lease. Similarly, as there are no changes to the lease liability on commencement, there is no change to the interest expense or outstanding lease liability amounts in subsequent years from having a social donation element. This slide shows the change to the total expense recognised compared to current FRS 102. The total expense is increased by the increased depreciation charge due to the higher starting value of the right of use asset. with total expenses being 375,000 over the 5 years, compared to 250,000 under current FRS 102. The right of use asset recognised includes the 125,000 social donation element, and therefore this is expensed over the period of the lease, giving an increased SOFR charge in each subsequent year. In effect, a lease arrangement with a social donation or a non-exchange element will have the effect of a higher level of funds on commencement of the lease, but a corresponding increased charge in subsequent years. In this scenario, you might want to consider how this could impact your reserves policy or your free reserves presentation if it's significant. Finally, as you might expect, the draft SORP introduces specific disclosure requirements to go alongside these changes in relation to social donation leases and peppercorn arrangements, both for lessees and for lessors in such arrangements. This disclosure requirement seeks to ensure that users of charity accounts are able to properly understand these types of arrangements and the impact of such arrangements on a charity's finances in future periods. So I appreciate these examples might sound quite complex, especially for the first time through, and we've gone through them quite quickly. But do remember, as Fiona said, all the slides will be available later so that you can go through these again in your own time. I will now hand over to Robin, I believe.
Thank you, Sarah. So in this section, I'm going to provide a flavour of the income amendments in the exposure draft before considering some of the other financial statements proposed, financial statement changes proposed in the SORP. So in a similar manner to the lease amendments that Sarah has taken us through, the income recognition module has been updated to include new accounting requirements for revenue recognition for exchange transactions based on the 5-step model that's in FRS 102. The income recognition module in the SORP has been split into 2 parts. So firstly, income from exchange transactions for which the 5-step model is applicable, and secondly, income from non-exchange transactions. The SORP continues to require the use of the performance model when recognising grant income. Therefore, income will continue to be recognised as performance-related conditions are met, and the 5-step model for contract income will not be applied for non-exchange grants. Additional guidance has also been included on the information available to charities when developing their accounting policy for recognising legacy income. So, such as where notification services like SME and Forward are subscribed to. As a reminder, the amendments to FRS 102 introduced a 5-step model for revenue recognition. This is for all contracts with customers. And this is based on identifying the distinct goods or services promised to the customer or third party and the amount of consideration to which the charity will be entitled in exchange. As I noted on the previous slide, non-exchange income, including grants, donations, legacies, are considered in a separate non-exchange transactions section of Module 5 and will not apply the 5-step model. The core principle of the 5-step model is that revenue should be recognised to depict the transfer of promised goods or services to customers, which are the performance obligations under the contracts. Examples given in the SORP of transactions to which the 5-step model applies include the provision of educational services by a charity in return for course fees, the sale of educational goods by an art gallery or museum charity, or the provision of serviced residential accommodation by a residential care home in return for payment. So the 5 steps are listed on the slide, and these are reflected in both the SORP and FRS 102. So step 1, we identify the presence of a contract with a third party. Step 2, we identify the promises made in the contract. This is to transfer goods or services that are distinct from one another. So each of these must be separable and the customer be able to benefit in isolation. Step 3 is to determine the transaction price from the contract in step 1. Step 4 is allocating that transaction price to each of the performance obligations, which we've identified in step 2. And then finally, in step 5, we recognise the income as each performance obligation is satisfied. So let's run this through a short example, which is a contract with multiple performance obligations. So a charity provides 12-month educational service and accommodation contracts. Tuition and residential accommodation are charged at a combined annual fee of £15,000 per year. A laptop is provided to each student that signs up to this package for no extra charge, and that laptop is available for their personal use. The cost of separately purchasing the laptop from the charity is £1,000. Tuition-only contracts are available for £12,000 per year. For the purpose of this example, we also assume that residential accommodation is otherwise separately available and charged at £7,000 per year. And also for simplicity, we've assumed that the charity's financial and academic year ends are consistent. So looking at this example under the 5-step model, we have 3 performance obligations that are separable and where the customer can benefit in isolation. So this is the provision of tuition for 1 year, the provision of accommodation for the same year, and the provision of a laptop at the outset of the contract. The standalone transaction price for each element is shown on the slide. So when combined, the standalone transaction price for all of these elements is £20,000, but £15,000 is charged under the bundled arrangement. So we now need to consider how the £15,000 transaction price will be allocated to each of the performance obligations identified in step 2 and at what point the income is recognised. So the amended standards and the SORP require that a charity must allocate the transaction price to each performance obligation identified in the contract on a relative standalone selling price basis, unless the contract either contains only one performance obligation or all the performance obligations in a contract are satisfied at the same point in time. The requirement to allocate based on standalone selling price is one of the amendments that flows through from the standards. So in this case, the charity will use the standalone price for allocating the share of the £15,000 to each of the performance obligations. The tuition fee represents 60% of the total standalone price, so 12k out of 20k. Therefore, the same proportion, being 9,000 of 15,000, is allocated to that performance obligation. The same approach is then applied to accommodation and the laptop obligations. There is an assumption here that the tuition and accommodation are distinct and separable performance obligations. But in some scenarios, it may be the case that there is a single performance obligation if the customer cannot benefit from one of these in isolation. The charity considers that the tuition and accommodation performance obligations are satisfied over time in line with the provision of the service. So effectively straight line basis over the course of the 12-month contract. The laptop element of the contract is satisfied on day 1 of the contract when passed to the student. The charity therefore recognises the proportion of the income attributable to the laptop at the start of the contract. So this is really intended as a simple example to show the principle of allocating contract price against multiple performance obligations. In reality, this situation may well result in consistent timing of income recognition between the existing and amended FRS 102. However, it's worth noting that the amended FRS 102 is more prescriptive in determining what a performance obligation is, how to identify a performance obligation, and how to allocate revenue between them. So now let's consider what other changes are proposed that impact the financial statements beyond revenue and lease amendments that are driven from FRS 102. So firstly, cash flow statements. The SORP Exposure Draft proposes that only Tier 3 charities, so being those with income over 15 million, will be required by the SORP to prepare a cash flow statement. This is a proposed increase from the existing SORP, which has a cash flow statement income threshold of 500,000. Tier 1 and Tier 2 charities may be exempt from providing a statement of cash flows, but only when they are also eligible for the exemption for small entities in FRS 102. So for periods commencing 6th of April 25, an entity is small if it meets 2 of the 3 criteria listed on the slide. So turnover is not more than 15 million, balance sheet total not more than 7.5 million, and average employees are not more than 50. I think really the intention of the SORP making body is that only the very largest charities are required to prepare the cash flow statement. But in setting the 15 million threshold, rather than aligning with the small entity definition, it follows that some charities that would otherwise be defined as small under FRS 102 will be required to prepare a cash flow statement under the SORP, and indeed vice versa. So to take the example of an endowed charity with total income of 5 million, total assets of 200 million, and 60 employees, the proposed SORP threshold would not require the charity to prepare a cash flow statement, as income does not exceed 15 million, but a cash flow statement would still be required under FRS 102, as the entity is not small. Similarly, a charity with 20 million of income that meets the small entity definition would not be required to prepare a cash flow statement under FRS 102, but the SORP would continue to mandate its preparation. So I think this is an area that does just need a little bit of thought, given we've got 2 criteria to apply. Moving on to expenditure presentation on the SOFA. In supporting smaller charities making a choice as to whether they wish to report expenditure on an activity basis or use natural classification, Module 4 has been updated to make it clearer how the SORP will appear depending on the basis of reporting selected. So the slide shows the example table from the SORP, which illustrates how the reporting on a natural basis could look in the SOFA. So this includes items such as salary costs, depreciation, grants, rather than expenditure on raising funds and expenditure on charitable activities. Important to note, though, this is only an option available to Tier 1 charities. Next is disclosure of remuneration and related party transactions in Module 9. FRS 102 requires outstanding balances with related parties to be disclosed. The SORP module has been updated to reflect this point as well. To ensure consistency with other guidance and the legal position, the SORP glossary definition of ex gratia payments has also been updated. Module 9 continues to define ex gratia payments as a payment or the waiver of a right to an asset which the trustees have no legal obligation or legal power to make from a charity's funds, but which they believe they have a moral obligation to make. The updated SORP glossary definition on the slide aligns with this, highlighting that trustees must A, not be able to justify the payment as being in the interest of the charity, or B, be under any legal obligation to make the payment. The glossary definition in the current version of the SORP refers to payments made at the discretion of trustees and not as a result of contract or other legal obligations. The update also aligns with other Charity Commission guidance, including CC7 on ex gratia payments. This is really about ensuring there's a consistent definition of ex gratia across different information sources. The SORP continues to require that the notes to the accounts must provide an explanation of the reason and nature of ex gratia payments, state the legal authority under which it was made, and state the amount of the payment or indeed the value of any waiver to the right to an asset. The exposure draft also proposes to remove the option to aggregate ex gratia payments and related party transactions. It is proposed that this is removed to improve transparency over these transactions. Finally, it's just worth noting that there are no changes proposed to the higher pay bandings, so the 60K and upwards thresholds or key management remuneration disclosure requirements. So a key change proposed in the exposure draft in the social investment section is the retirement of the terms program related and mixed motive investments, with the SORP simply using social investment to cover both terms. Social investments are defined in the SORP as investments made for both a financial return and to further the investing charity's purpose. This aligns the definition of social investments in the SORP with the Charities Act. As a result, the exposure draft proposes that all gains and losses on social investments are treated consistently and will be presented in the SOFA in the gains and losses on investments line. Whereas if we think about the current SORP, a gain on a program-related investment would be included within other income further up in the SOFA. So this may result in a change in presentation for some charities and may result in those charities being required to adjust comparatives on adoption of the amended SORP. For charities applying total return accounting, SORP has also been updated for changes arising in the Charities Act 2022. That act gives trustees a power to resolve to use a permanent endowment to invest the total return fund, or part of it, in social investments with a negative or uncertain financial return, provided that any losses are offset by gains made elsewhere in the relevant fund. So effectively the changes that are coming through from the legislation are proposed to be reflected in this in the updated SORP. And then finally, for heritage assets, the main amendments relate to the measurement of heritage assets that have been donated. Such assets that have been acquired by way of donation or other form of non-exchange transaction must initially be measured at their fair value. The existing SORP states that heritage assets donated to the charity should be recognised initially at their fair value where practicable. Amendments have also been made to include reference to heritage assets which may be held by a lessee as a right of use asset, although it is acknowledged that this scenario is likely to be uncommon. In terms of disclosure, it is proposed that a reconciliation of the movements between opening and closing heritage assets balances becomes a must requirement rather than an option, as is currently the case. And in addition, disclosure will also be required of depreciation or amortization charged on heritage assets in the period. So at that point, I will hand over to Fiona to wrap up this section.
Thanks so much, Robin. So before we go to the Q&A session, and just a reminder just to put your questions in the chat function at the bottom of your screen. Just wanted to refresh your memory then of the key messages that we are communicating today. So the consultation is open until the 20th of June. Please do take the opportunity to have your say. The final SORP won't be issued until late autumn 2025, and the SORP cannot override changes from the amended FRS 102. There will be a very short period between the finalisation of the SORP and the effective date, so it's really a good idea to try and get ahead at this point. In terms of the trustees report, there is this introduction of tiered reporting that primarily affects the trustees report. Additional disclosures will be required around impact reporting, sustainability and volunteer disclosures, to name but a few. And I think it's really important at this stage just to think about who your stakeholders are, what their expectations will be so that you can plan ahead. In terms of the financial statements, the two significant changes that we anticipate are around the income from exchange contracts and where charities are lessees. We've got these specific requirements for social donation leases, and I would stress that that is currently in the exposure draft, but that may be one of the areas particularly that you want to feed back on. There are some practical expedients and exemptions for low value assets and leases, and limited other amendments. So the question is, do you have the data, the expertise and the tools to implement the changes? So my colleagues have now joined me on the screen, and we've got 10 to 15 minutes now to use this opportunity to pose some questions. And I'm delighted that Fred Lakatu has joined us as well from a financial reporting advisory perspective. So perhaps, Fred, I could start with you. Having had the experience of going through the equivalent standard changes in IFRS, what's the advice that you would give charities at this stage?
Thank you, Shanae. Good morning, all. Yes, it's a very good question. Our experience supporting IFRS reporters brings insight that charity organisations may find helpful to consider for preparing for this accounting requirement, and preparation is key. Essentially, time is of the essence. But for me, and in my experience, that includes a few things, including number one, understanding and applying the accounting requirements. It's quite critical to sort of get one's head around the SORP in particular, and take time to read what it means and what it means for you. And starting to prepare position papers will be quite important. The thing that we haven't talked about this morning is particularly there are some volumes in these agreements, is to think about the housing and the filing of the supporting contractual documentations. So data collection will be very important. So where is the lease information? Where is it? Who's holding it? How can we access it and look at it? The next challenge will be about extracting the financial and non-financial data around lease terms, around payment amounts and schedules, renewals and termination options. All the data that will be required for computing the lease liabilities, including the discount rates. The next challenge will be around computing lease liabilities and right-of-use assets. I think there's a big spreadsheet risk here, and I think it's okay if we've got one or two, a handful of leases, but as soon as volume crop in, would recommend sort of use software solutions such as our video proprietary software, Video Lead, for example. Reporting, budgeting, and forecasting will change, so it's important to think about the covenants and KPIs and incentives and how these will be affected by the new numbers being reported. And then finally, preparing specific financial disclosures in the financial statement, which will be quite different to what you are probably used to.
Thanks, Fred. And do we have anything we can do to help clients ourselves?
Certainly, I think we do provide lease accounting managed services. So I think we provide a whole suite of services from on-call financial reporting advisory with our specialists. We can advise on process re-engineering for lease accounting, and obviously we can provide lease solutions, software solutions such as Video Lead to help the computation of the lease liabilities and manage that for charities and for clients as we do.
Thanks. Thank you, Fred. So another question, I think it's probably for Robin, is from an audit perspective, what would we be expecting charities to produce as evidence for changes or non-changes in revenue recognition?
Yeah, it's a good question. I think firstly it's important to take a step back, and I suppose there's not really a distinction between how we would approach the audit of contract income with how we audit other balances and transactions, in the sense of auditors need to understand the controls, the processes, the governance, etc., that underpin the amounts that are recognized in financial statements. Those it reflects some of the points that Fred's just made, in that if we're considering revenue, we need to consider, well, what population of contracts do you have? Do you have complete contract databases? What controls do you have around updating those, ensuring that the appropriate people within finance teams are reviewing those contracts and identifying the performance obligations, considering whether they are distinct, separable, and then how that then flows through to income recognition. So there are definitely in some cases additional sort of data capturing data capture that will need to be put in place, ensuring you've got complete records that ultimately then inform the recognition. But ultimately, when you're looking at an individual contract, it's, as auditors, we would expect to see that contract has been properly considered, the performance obligations have been pulled out, and that they've then been considered against the requirements that are in quite some detail in the SORP and FRS 102.
Yeah. Thank you. Thank you. A question that I'll take for myself actually here is it possible for a charity company with a 31st of August 2025 year end to early adopt both new FRS 102 and new SORP, given the SORP release would be after the year end? And I think that's an easy one to answer, because you can't adopt something that hasn't been fully endorsed and issued. So with an August year end, you could early adopt for August 2026, which would be earlier than the mandatory requirement for you, which would really fall to August 2027. But August 2025 is too early at this stage. Another question on, Robin, while you're there, on income recognition. We know that a lot of charities have contracts with local authorities. Some prefer to enter into them as commercial contracts rather than grants. Do we think that in itself is going to cause any issues in terms of applying the 5-step model?
So I think, again, I suppose there's the distinction between grants and contracts, in the same way that there is under the existing standards and existing SORP. So a charity will need to consider the substance, the exposure draft sort of sets this out as well, but the substance of an arrangement needs to be considered. If a charity has entered into a grant, and the SORP makes it clear that the non-exchange section of Module 5 applies, and income is recognised based on performance model, i.e. you consider the performance-related conditions in the grant and recognise when they have been fulfilled. If you have a contractual arrangement, in this case with a local authority, then yes, potentially that does fall within the scope of the 5-step model. That said, you need to consider each contract on a case-by-case basis. So if you've got a situation where you've got a 12-month contract to deliver a service, that service is aligned with your financial year end. The actual output in terms of will this change your income recognition may well be not. But if you have a contract, you need to go through that thought process and consider the obligations within the contract, whether it affects the timing of income recognition.
Brilliant. Thanks, Robin. One for you, Sarah, I think, is around the discount rate that you might use at the when you're doing the calculations. If the cost of borrowing or the equivalent rate changes during the course of the lease, will we have to keep updating those calculations?
Thanks, Fiona. So no, you would set that at the beginning of the lease. Similar if you were discounting grant expenditure, grant commitments. You set that at the beginning of the excuse me, at the beginning of the contract, and you wouldn't change that through the lease. But each year you would set your discount rate for agreements beginning in that year. There's Robin, if you have anything to add on anything on the discount rates.
No, I think that's right. I mean, there is a lot of again, there's a lot of detailed, nuanced situations around modifications of leases, and at what point a modification amounts to a new lease or an amendment to existing lease, which is, as I say, it's covered in some detail in FRS 102 and the SORP. But from a principal's perspective, set a discount rate at the outset of the lease at the point of commencement, and that flows through.
Yeah. Great. Another question that I'll take myself is around what happens with tiering and you move from one banding to another, and it could only be for 1 year, or it could be unexpected because of a legacy recognition. And the question is, well, what do you do then if 1 year you're in tier 2, the next year in tier 3, and then you're back in tier 2? I think that's a brilliant question, and one which many charities will grapple with. And actually, it isn't clear in the exposure draft what you would do in that situation. So in the Companies Act, we do have some clarity around whether it's a successive year change or whether it's 1 year of change. So if you feel that you could be in that situation, that's definitely something I would encourage you to respond to as part of the consultation, because I certainly think charities will need that clarification. Some people only do fundraising events biannually, for example, so you could be flipping in and out different tiers multiple years. Next question on leases is, are there choices for retrospective adoption of the lease changes as there were for IFRS 16? Sarah, you able to answer that one to Robin? Well, I suppose more generally, what are the transitional requirements that people need to be aware of? Robin,
Yes.
have you got, or Robin or
No,
Sarah?
go on, Robin.
Sorry, apologies. Yeah, so the requirements on transition again flow from IFRS 102 in respect to leases and revenue. So leases, there isn't the option to restate comparatives. So effectively any impact on, so if you're a December year end, first applicable year end here will be December 26. So you would there would be an adjustment to any opening reserves as at 1 January 26 for the effect of the lease amendments. Many cases that won't be a change, but in some cases there may be, particularly where if you've got things like social donations to consider. For income, IFRS 102 has the option to restate comparatives. So in the example, to go back to 25. But as I say, there isn't the option to retrospectively restate 25 for leases. I mean, that was intended as a to make the adoption simpler, more straightforward.
Yeah,
Right.
I would just add to that, to your point, Robin, this is a simplification measure that there's no need to set a comparative, but there's also practical expedient available. For example, if a charity was a subsidiary of an IFRS reporter, you could have the option to sort of use these numbers in its as a transition date to avoid any remeasurement. So there's a practical expedient, which is unlikely to be seen in practice amongst charities, but it's good to be aware of it.
Thanks, Fred. Another quite long question has come in around legacy accounting. I mentioned that there's a requirement to add more narrative around how legacies are accounted for, to help users of accounts understand the difference between accruals and income. In the exposure draft, we've now removed the reference to entitlement, and it just talks about measurement and probability. So the question that's being posed is, do we think that there will be an earlier recognition point for charity legacy income? I mean, I'm happy to start that one off, but also interested in views from Robin and Sarah. But I think from my perspective, what we're looking for now is more consistency. So I think the starting point is a much more granular accounting policy and an explanation of how you determine the point at which you have measurement and probability. It is going to be more complicated for some charities, but certainly when we've done research on the amount of legacy income that's recognised and the amount that's disclosed as in the pipeline, we do see a lot of variability. And that implies that at the moment there is still quite a significant range of different accounting policies that result in some legacies being recognised much later than in other situations. So I think if you do get legacies, it's worth engaging in the area of the exposure draft that covers this and think about what would that really mean, both in terms of disclosure, but also accounting. The exposure draft has clarified, for example, that grant of probate is one measure of probability and measurement, but obviously in Scotland there is still no probate system, so there is always that alternative view to looking at that. Robin or Sarah, have you got anything else to comment on in terms of legacy accounting, particularly the challenges?
I'm not sure it hugely changes what we would have said before in terms of, probate could be a starting point, but there are other factors to consider in terms of when something becomes, probable and and measurable for recognition. So I think those bases still stand in terms of what the actual scenario and specifics of the legacy is. But you're right, more information around how you are making those judgments will be required in the accounting policies, and more detailed considerations at year end in terms of specific legacies and the factors affecting them, I think is probably the key message.
Yeah. Thanks, Sarah. Listen, I've just seen the time. It's 10:30 now. We actually still had like 20 questions in the chat, so we know that this is galvanizing some interest and sparking some questions. So as I said, we will endeavour to respond to those questions probably as a sort of FAQ document for everybody. So I know you're all really busy people, so at this point I'm just going to wrap up and say thank you so much for joining us today. I really hope you found this useful. We know there's a lot of detail to think about, and that's why we've provided some real life examples. The slides and the recording will be available next week. So please do engage with that and come back to us if you've got further questions. And on this slide, I'm just showing you where to go for more information, either on the exposure draft itself, some information on the SORP microsite, and just reference back to a FRS 102 comparison document that we produced towards the back end of 2024, which takes you through old and new changes to FRS 102 itself. So without further ado, I'm going to close today's session, but thank you so much, and we hope to see you at our next session, which will be later in the autumn, when we can finally take you through the absolute known changes and help you with your preparations for your next set of accounts. So thank you so much and have a great day.